Welcome back to Success with Steven. My name is Steven Smith. On this channel, we discuss all things financial literacy. Recently, I recorded a video on business funding sequences and credit card stacking, and it seemed to spark a conversation about structuring your personal credit. Now, before lenders or credit card issuers take a serious look at your business, they often peek into something much more personal, your credit profile. And in many cases, especially if your business is new or doesn't have much credit history of its own, your personal credit profile can make or break your shot at getting approved. So in today's video, I'm going to show you exactly how to structure your personal credit profile to look rock solid and ready to impress lenders. So if you're aiming for maximum funding, whether it be for $10,000, $100,000, or even beyond that, this is the roadmap to get you there. So without further ado, let's get right into the video. Now, to begin, I want to discuss your credit profile versus your credit score. I think that's an appropriate place to start. Having a high credit score will give your financial health a boost, and it makes other financial goals much easier to obtain. And people who have high credit scores normally have access to better interest rates, higher chances of approvals on new credit, and other benefits. And that's why it makes it all the more surprising when someone has a high credit score and gets denied for business funding. Your credit profile is more important than your actual credit score. And before we continue, I want to clarify something. Your personal credit score often is the gateway to business capital. Business lenders want to see that you manage your money well before you can handle theirs. In fact, most lenders prefer to see a FICO score of at least 680, but that 680 is weighted upon many different things. A 680 credit score with 15 or more primary accounts is actually better than a 750 credit score with 3 primary accounts. Think of your credit profile as a job resume. If you were looking to hire someone for a job, would you want to hire the person that graduated high school with a 5.0 GPA or the guy who got his master's degree but has a 4.0 GPA? One person has a much higher GPA, but the person with the master's had to take much more difficult curriculums in order for him to actually get that degree, which is more heavily weighted. So when you're looking at credit scores versus credit profiles, just know that it's about the quality of the accounts and how they're weighted against how well you handle debt, not just how high your score actually is. 90% of business funding is based on a personal guarantee. And your FICO score is calculated based on 5 key factors from your credit report. Payment history, which is 35%, amount owed or utilization, which is 30%, length of credit history, which is 15%, new credit, which is 10%, and credit mix, which is also 10%. These factors are combined using complex algorithms, but the general idea is that a history of on-time payments, responsible credit usage will result in a higher credit score. We're going to discuss each of these factors and discuss what you need to do with your personal credit profile for maximum business funding. There are at least 16 different versions or models of the FICO score, and some reports even mention more. These different versions are used by various lenders for different purposes, and they can vary based on the credit bureau that's using them. For today, we will primarily be focusing on your FICO Bank Card 8 score because most individuals use business credit cards when they're trying to secure business funding, especially in the beginning. Your FICO Bank Card 8 is designed to be particularly sensitive to credit card usage and balance, which is more important to assess the risk of a credit card holder defaulting. If you want to learn more about different FICO scoring models, I have a video that covers each one. I highly recommend that you check that out. But once again, for the purpose of this video, we're focusing primarily on your FICO Bank Card 8 score. Factor number 1 is on-time payments or payment history. Now, this one is huge. Lenders want to see that you've consistently paid your bills on time. If you miss one payment, and that means you let it go by for 30 days, lenders might report to the credit bureaus once this happens, and your score can drop anywhere between 60 to 100 points, especially if you have a high credit score to begin with. That one missed payment can stay on your credit report for up to 7 years, and multiple missed payments start to look like a trend. So that's when lenders want to pull back from you completely. You might still get approved for some funding, but you'll definitely have higher interest rates and lower limits. So the bottom line is this is the most heavily weighted factor of your credit score. And if you want to secure business funding, you should absolutely positively have no late payments. If you have any late payments, I highly recommend that you check my credit repair playlist below. I do have some videos that can potentially help with that and get those late payments updated to paid on time. Factor number 2, utilization or credit usage. This refers to how much available credit that you're currently using. And I'm sure that you've heard this 1,000 times, but you need to have your credit utilization under 30%. Sub 10% is ideal. And yes, that is good for your credit score. But today we're talking about credit profiles and structuring them for business funding. Now, the first thing I'm going to point out in this section is highest balances. You also might see recent high balances depending on the report that you're looking at. There is an actual snapshot of how much of your credit that you have used in a certain period of time. Now, what you'll notice is this is a credit limit of $10,500 and the highest balance actually used is $9,662, but the credit usage that's reported is 3%. This would be ideal for business credit funding. I want to be as clear as possible on this. That 9,662, that's a screenshot from my report, but I never carry this balance over into the next statement cycle. This just means that on this card, I actually used $9,662 and I paid it back. That's important to note. You need to show that you're using your card as well as paying it back. Now, why is this good for structuring your credit profile for business credit? Let's say you have $30,000 or $40,000 on a credit card, but you don't have any recent balances or recent high balances in the past 6 months. You're not showing that you need access to more capital. Now, I'm not suggesting that you spend high amounts on your card that you can't feasibly pay back, but I'm just saying you need to put some usage on it. So for example, I screenshot a lot of my business funding denials. That way I can take a look at the adverse letters to understand why I was denied. Now, I've been denied before because my credit balances have been low, meaning they looked at my credit lines, seeing that I had very large limits, but yet I wasn't using them. If you're not using them, the bank cannot make money off of you. They make money from interchange fees. They make money from interest. So if they see that you're using a $20,000, $30,000, or even $40,000 card, and you're using that very frequently with high balances, they're going to see you as someone that's profitable and they can make money off of you. And chances are they're going to give you a limit that's relatively close to what you currently have. So if you have a $10,000, $20,000, or $30,000 credit card on the personal side, which is also important, then they're going to give you that exact same thing or even more, especially if you're using high balances, but your utilization is as low as this, like 3%. This is showing they can handle high limits. They also use the card and they pay it back. That is a profitable client. They are going to be more inclined to give you higher limits just based off of this. Not to mention if you're not using your card, and I've seen this plenty of times because I have worked for a few different banks. If you don't have any activity on your card for around a 6-month time frame, you are likely to get a credit limit decrease. Meaning if you had a $20,000 or $30,000 credit card on the personal side and you haven't really used that card much in 6 months, they are likely to decrease your limit. So just be aware that that's something that can happen, but you want to maximize what you're actually doing on your card in order to qualify for maximum business funding. Factor number 3 is your length of credit history. Now, the length of your credit history refers to the time that your credit card accounts have been open, essentially the age of your credit history. Now, this is a factor used by credit scoring models like FICO to assess your credit worthiness. Now, honestly, credit history is one of those things that you just have to simply let your credit age. There really isn't much that you can actually do about it. I will say that when I was first getting business funding, some banks would not even approve me because they said the average age of my accounts was too new. I couldn't get it just because I did not have a lengthy credit history. Now, there is something that you can do in order to get more credit age. One thing is getting authorized user trade lines added to your credit report to extend your credit history. There are things like Trade Line Supply Co. or Coastal Trade Lines where you can get primary trade lines with long account age, and you can have them on your credit report for around 2 to 3 months for a certain price. Now, the reason why I don't really like to use it in this situation is because it's like a Band-Aid on top of an open wound. You really have to actually age your credit report to a certain degree. You can use this to help, but overall, you're going to be paying money in order for this to only stay on for like 3 or 4 months. Now, maybe you can use this when you're doing your business funding sequencing and you're only doing like 1 or 2 rounds. You can temporarily increase your age by using an authorized user trade line. And then once it falls off, you can wait until you need to do your next round and you can do it again. But I recommend that you open accounts and you let them age on their own just so that you can get some actual age and it's not artificially created. Another good tip is if you have a family member, if you have a friend that has a really high credit line, or even if the credit line isn't that high, if they have some pretty good age, I highly recommend that you just ask them to add you on as an authorized user. Let them know you do not need a card. This will not affect their credit report. You just want to have the age that they have associated with their account, but you want to do your research. There are authorized user trade lines that don't report the history. American Express is an example. They'll add you on as an authorized user, but the account starts from the day that you add that account on. Now, there are other banks that don't do that. If you look at Coastal Trade Lines or Trade Line Supply Co., you look at their websites, they will actually show you which trade lines or which banks rather will report the actual history. All right, so just keep that in mind if you have a family member or a friend that can add you on. Factor number 4 is new credit. New credit refers to the number of recently opened credit accounts and inquiries made on your credit report, and it's a factor that reflects how actively you've been applying and opening new lines of credit. Now, it might seem a bit strange at first, but the newer you are to the world of credit, the less likely you are to get approved for business funding, regardless of your credit score. In practice, however, it makes sense. Lenders need to feel comfortable lending you money, and they want to see an established history of credit products with consistent payments, and they want to see that over a long period of time. It kind of goes into the previous factor. Now, if you're applying for your first or second, let's say, loan, you don't have a long enough track record with payments, meaning you're more of a risk to lenders. Now, new credit may seem like a catch-22 because when we get to our next factor, credit mix, you do need to have multiple types of accounts in order for you to actually have a profile that is very well structured. However, at the same time, the more accounts that you open, the shorter your credit history will be. My recommendation is that you open up as many accounts as you can early on, and then you let your account age. If you're doing business funding sequences, you can again average your age out, add on some new accounts, but you do have to let them age in order for this to be more effective. Factor number 5 is credit mix. You guys really want to build out with multiple financial institutions due to underwriting. If you build out with multiple creditors, when a product or a new promotional offer becomes available, you will already have your foot in the door. In terms of business funding, when you branch out to multiple institutions, you get familiar with their underwriters. And I'll use my situation for an example because I have a great relationship with Navy Federal Credit Union. They've approved me for every single product that they have, I think, besides a mortgage. And seriously, I've been approved for everything. But if I go to Bank of America or if I go to PNC, they do their own in-house underwriting. You want to build out with multiple financial institutions to get a relationship with them. So if you have, like, let's say a Chase credit card, you also have a Wells Fargo credit card on the personal side, and then you have a Bank of America credit card on the personal side. When you go to get business funding from them, you already have your foot in the door. They are more likely to give you higher limits. They're more likely to give you more products. So I know it sounds like a lot of this doesn't actually make sense because if I open up 5 cards here, then it's going to shorten my average age and history. And then if I do that, then my credit mix. The thing is, guys, structuring your personal credit takes time. This isn't like a thing that you could just do like overnight. There are little tips and tricks that you can use to try to get it balanced out as much as you can. But honestly, this thing takes time. It takes time to structure out your personal credit in order to get maximum business funding. But let's summarize everything that we talked about. And then again, I'll show you how someone could do this, or how I would recommend you do this if you were brand new. Now, to bring this all together, this is how a structured credit profile should look in order to get maximum business funding. You want to have around 8 credit accounts, but you want them to be mixed. And this could be like, let's say 4 revolving accounts. I would say credit cards with $20,000 or more in credit limits. I would say have 2 installment loans at least, and then have 1 auto loan. Now, notice that adds up to 7, but I said 8. You could have 1 other credit card there. You can have another installment loan. Me, myself, I have 2 auto loans. You could have a mortgage. You just want to have at least a little of each type of account on your credit profile. And I would say that 8 would be a good mix. I do think a majority of the accounts, though, should be credit cards. You want a majority of them to be revolving credit lines with at least $20,000 or above. Now, here's how you can achieve this if you were new to credit. You are more likely to get higher limits from credit unions. I highly recommend going to your local credit union. If you're not a part of Navy Federal, there are some national credit unions that everyone can join. I recommend going to them, opening an account, building a relationship, depositing money, set up direct deposit, get some products like a CD, anything like that, get a credit card, and then increase your limit. So many credit unions are known for giving you high limits. I also have another card with Synchrony Bank that had a $1,000 limit, and in 1 year, it now has a $16,000 limit. Synchrony Bank is very well known for doing really quick credit limit increases. Or there are also credit cards like certain Chase cards that have a baseline. There are certain credit cards that you can open where $10,000 is the known starting limit. For example, there are certain Capital One cards that are like that. Find cards that have a baseline where they start at least $10,000 and apply for those. If you don't want to build a relationship with the credit union, that's my recommendation to get started. If you apply for, let's say, 4 of those, you're guaranteed to have a starting limit of $10,000. When it comes to installment loans, my recommendation is getting a personal loan with something like Lightstream, or you can get it with SoFi, or you can get it with Discover. A lot of these places are really good, especially if you've never had a personal loan before, and more than likely they will give you loans up to $20,000, $25,000, $30,000. I'm not saying to take out a personal loan if you don't feel comfortable, if you really don't need it, just to structure your credit profile. If you don't feel comfortable with doing that, you can do something like a Navy Federal secured loan or a secured loan with any other bank. If you have bad credit and you're rebuilding, commercial accounts like Ava, accounts like Kickoff, in-store credit cards that can only be used in one place, those actually are not good for structuring your personal credit. Now, everything has a purpose, okay? If you are unable to actually get qualified for a lot of even secured cards, we all have to start somewhere. I personally still have Kickoff and Ava on my credit report, but I'll probably stop using them soon. That did not stop me from getting business funding. However, I have been denied in the beginning because I had too many commercial accounts. So while credit builders do serve a purpose in helping you rebuild your credit, I would also say you want to pair them with at least 1 or 2 secured credit cards, like the Navy Federal Cash Reward Secured Card, or some other ones that can graduate and give you a high limit at a later time. You want to think about that in the future if you are in the rebuilding phase. When it comes to utilization, you want to make sure that you're using your personal credit cards often with heavy usage, but keep your utilization when your statement cycle date closes below 10%. If you do that, you will be in the perfect position for you to get qualified. Again, banks want to know that they can make money off of you. They want to know that you're profitable. You want to use your credit heavily to let them know that, 1, you can handle it, but secondly, that you're going to actually use their products and services. If they see that you used a high balance and paid it back responsibly with very low usage, they're definitely going to want to give you more capital. If they see what you did with a $20,000 credit card, they might want to give you 40 just because they see how you handle it. So always keep that in mind. Your usage is important, but your utilization should be low. I hope that makes sense. Now, for your account age, this is the strategy that I used when I started. I kind of knew I wanted to have at least 2 years of account credit age. My thing was, when I got to hit the 2-year mark, that was when I was able to go over and get an 800 score. Again, the score is not the most important part, but I did notice that something about when you get past 2 years, you get an extra 30 points and it puts you in a different category for your account age. It's very, very weird how that works. The point is, you do want to let your accounts age. So if you were, let's say, in the rebuilding phase right now, my recommendation is, again, open 1 or 2 secured cards, let them age, and then increase your credit limit. All right. You really want to be careful with age. Imagine that you have 3 credit accounts and their age is 5, 7, and 10 years. And yes, you can have an account for 10 years. If you have a closed account and it's positive, it can report to your credit for up to 10 years. I just want to point that out in case anybody didn't know. Your average credit age at that point would be 7.33 years. And you would calculate this as 5 plus 7 plus 10 divided by 3. Now, let's say you open a new account. You had a 4th account. That account will be at 0 years old. And you can calculate your new account age by adding 5 plus 7 plus 10 plus 0 and then dividing that by 4. Your average age would be 5.5 years. So that wouldn't really have an impact on your score. You probably wouldn't be able to get any business credit cards for at least 90 days once, because that account was so new. But after that, you pretty much would be in good shape, right? Because the average would not be too bad. It'd still be above 2 years. I would say 3 to 4 years is a great sweet spot. But in that scenario, you would be okay. And this is why I don't recommend closing old accounts that are in good standing, because you want to keep the age and help keep that average high. You don't want to close accounts and have that average shrink. So with that being said, if you have bad credit, go ahead, open up new accounts in the beginning, let it age as much as you possibly can, and then don't get anything. As you age, you can then slowly open new accounts and get that average to come down slowly, but only once you get past a certain point. If you have good to excellent credit, but your credit profile is thin, my recommendation is to look at authorized user trade lines when you're doing your business sequencing, or you can ask a family member or a friend if they can add you on to extend your age. Again, you don't have to hit every single one of these factors. I'm just telling you what's the most ideal situation. And if you ever get an adverse letter in the mail that says, hey, you were declined because of the average age, then you know, oh, I can go do the authorized user trade line ad to extend this out and see if this helps me get approved in, like, let's say 30 days. And again, when it comes to new credit, you really can't avoid having a good credit mix. You want to have that good credit mix, which means you're going to need to have new credit. And then the aforementioned tips that I just gave would help you in that scenario. And this is how you would structure a credit profile in order to get maximum funding when it comes to business credit. Thank you guys so much for watching this video. I truly appreciate you guys. If you have any questions about how to maximize your credit profile, please drop that in the comments below. If you would like me to make more videos like this in order to give you tips on how to structure your credit profile for business funding, I'd be more than happy to do so. Once again, thank you so much for watching, and you guys have a wonderful day.